Welcome to Wealth Matters Podcast. How are you, Peter, today?
Doing very well. Thank you for having me.
Absolutely. So Peter Fischer is a partner with Sklar, Kirsh LLP and a member of the firm's corporate and real estate practice groups. He's an experienced commercial real estate transactional attorney whose clients include developers, operators, syndicators like me, private equity providers, investors, and lenders. Peter has closed or supervised transactions totaling nearly $3 billion. So yeah, welcome, Peter. Can you tell us more about what do you mean by transactional attorney and syndication, etc.?
Sure, absolutely. So I'm Sklar Kirsh is a boutique law firm. We're about 35 lawyers. We're a pretty wide practice, both transactional and litigation. My practice is corporate and real estate. I don't go to court. I just put deals together. If they fall apart, I let somebody else handle that and the problems. But so I'm, documenting anything from forming companies, corporate sales, purchases of properties, putting syndication documents together, which is, I guess, what we'll talk about today.
Right.
Any and all contracts really on the corporate or real estate side.
Got it. So not only just syndication, but any real estate transaction as well, right? So a lot of time, I'm closing a deal and I need a real estate attorney to go through my contract, right? Purchase sale agreement, etc. So you can help with those as well, right?
Yeah, we do everything from sort of the acquisition through disposition, everything between leasing, the capital raising, and all different asset classes, right? Multifamily, mobile home parks, self-storage, land. A lot of fund formation. Okay. So it really runs the gamut.
Yeah, that's awesome. So do you invest in real estate or syndications personally?
I do. Actually. That's I was a lawyer before I was a syndication lawyer, and I started getting interested in real estate and investing myself, which is sort of what moved my practice over to sort of focus on the real estate side.
Awesome. And where do you invest, or how do you invest?
I met a lot of people through the LA market here. I don't know if you're familiar with meetup.com.
Oh, yes, of course.
Through Meetup, I met this group called Phoebe, which is for investors, by investors.
Yes, I have heard of them. Yes.
Okay.
Yes.
Yeah. So there's a guy, Jeremy Roll, who you may know.
Yes, of course. That's why I'm like, yes, I know Jeremy.
So I met Jeremy very early on, before Phoebe started, and he had 10 or 12 of us around his table in his office with stacks of economic data, and that was sort of my introduction to real estate. And then I met a woman who later became my first client, and I started just interning, learning a bit about real estate from her, and sort of got through sort of 12 of her properties and how they function.
Nice.
And just kind of got introduced to the world of like private real estate syndications.
That's awesome. So you just brought up syndication. What is a syndication?
Yeah. So the best way to think about a syndication is, right, if you are raising capital from a group of individuals, and those individuals have virtually no or little control. In other words, they're giving you the money, and you being the operator, and they're saying, okay, I'm writing you $10,000, $25,000, $100,000 checks, and you pool that money together and you buy, let's say, a multifamily property, renovate it. You're running the show and as the developer and pooling that money together, really.
Got it. So it's similar to, I would say, as an investor, I'm investing in stock, but I have nothing to do with that business, right? So
it is similar to that, yeah. I mean, in most of the stocks you're investing in are public, right? I mean,
right. In this case, it's private.
Syndications are private, but it's sort of the same. You're buying little pieces of membership interest.
Yes, exactly. Shares.
And exactly. That's exactly right.
Yeah, cool. So I'm acting as a passive investor pretty much, and someone else is running the entire show.
That's right.
And so in syndication world, how does the syndication start or work, right? What kind of documents are sent to investors, etc.? If you can give us an idea.
Yeah. So when you're in the syndication world, you're talking about a real estate deal, or really you can do it in any realm. But in real estate, you have to be worried about the real estate laws, but also you're selling securities.
Right.
Because when people are buying interests in the company, even though you're doing a real estate transaction, that is a security. So you need
Right.
what's called a private placement
Okay.
memorandum, or some kind of disclosure document that's your securities disclosures. You would typically have an LLC, which is the syndication vehicle. So you have an LLC operating agreement, and then you have what's called a subscription agreement, which is the document that the investors will execute, and say, here's how much I'm investing. I understand, I've read all the other documents. I'm an accredited investor. It can be accredited or
Or
sophisticated.
sophisticated.
We
Right.
can talk about that too.
Right.
But those are the three main documents that you're liable to see.
Right.
One variation or another.
So PPM and OA, right? Operating agreement and subscription agreement. So because most of my listeners are passive investors, so I want to look at it from passive investor.
Sure.
Which document out of these three is the most important? I'm assuming all of those are important, but which document?
Yeah.
Because I've seen the PPMs could be 100 pages, right? So as an investor, as a passive investor, I want to focus on the document which is really important, and I go through that document thoroughly, right? So
yeah. I mean, I think you're right. I think all the documents are important, but and you should read them or have an attorney read them. But most passive investors don't read through every page of a 100-page PPM. So I would say the operating agreement is the most important, because that really contains the provisions that govern, how the sponsor manages the transaction. It would have a distribution waterfall. It should lay out all of the fees, that the sponsors can receive. So that really should have the main terms of how the deal is going to happen and what the fees are and how you're going to get paid. Sometimes people draft their documents, so some of that is in the PPM, some of it is in the operating agreement, but really all of that should be set forth in the LLC agreement, and often in both places. But
okay, got it. So all of that should be in operating agreement, but there is a chance they may not be. Then of course you want to make sure you go through the PPM as well. And just to remind my listeners, PPM is private placement memorandum, which Peter already mentioned. So when we are going through PPM and OA and subscription agreement, hopefully everyone will be able to catch those phrases, right? So
and sometimes you might have an operating agreement with a disclosure exhibit instead of a full PPM. But it's in essence the same function. The PPM is where all the securities disclosures, and it'll have 3 pages of deal explanation, and then 20 pages of here's how you're going to lose your money, kind of thing.
Right. Of course.
So all of the reasons,
all the risks
and risk factors.
Yep.
So sometimes that's collapsed into, like I said, either an operating agreement with an exhibit that explains all that, or a subscription agreement with risk disclosures in it. But often there's 3 separate documents.
Got it. Yeah. So when I was a passive investor, when I started investing in syndication about 4 years ago, I would rarely read PPM and OA.
Right.
Now that I'm active as well as passive, right? Because any deal I raised capital for, I'm also investing passively, right? So I'm reading for the sake of myself as well as my investors every time thoroughly, right? But yeah, it's very important to go through those documents, because a lot of time it's we just don't read those documents, right? So what are some of the items or paragraphs investors should focus on while going through these documents? Like, is there anything investors should be focusing on?
Yeah, I mean, there's a couple of sort of main key provisions. The first being the waterfall, which is the flow of distributions. How you get paid. Is there a preferred return? What is the split to the manager, and is that after a certain IRR, a certain return
Right.
to investors.
Preferred return, we call them as
Right.
preferred. Yep.
Right. So hopefully, and sort of typically, right, there's a preferred return that is, let's say 100% of the dollars that come in go to the investor until they get an 8% preferred return, let's say.
Right.
And then there may be a split between, if you have like a multifamily property, cash flow from operations, rental income, and then what happens when there's distributions on a sale or refinancing. So those are very, very important. Obviously it shows you how and when you're going to get distributions, and it usually says distributions will be quarterly or biannually or whatever that
or
is.
annually. Yep.
So that's a really important section. And then you want to look for, what are the fees? How else is the sponsor getting paid?
Right.
Maybe the distribution section will say 100% of the operational cash flow goes to the investors, but then, if the sponsor is getting 20% of the money up front in fees,
right,
before there are any distributions, that's obviously not helpful to the investors.
Right.
And once you look at, several deals, you'll get a sense for what is market in like a value add multifamily deal or, a construction deal. So in addition to those two things, I think you want to look at the reporting. What are you going to get from the sponsor as far as, reporting, quarterly reports, information. It's important to look at the transfer provision section. What happens if you have a liquidity issue?
Right.
Is there a way to sell? And typically there's not, right?
That is almost,
right.
It's very hard.
But at least you want to see, hey, I can transfer this to another member maybe without the manager consent.
Or a friend or someone, Yeah,
and for, trust purposes, estate planning.
Right, that's true.
So those are important things to see. And then really the capital raising and management, right? So are you going to be required to put in additional capital ever?
Oh yeah, capital call.
Hopefully there are no mandatory capital calls in the future.
Right.
And then, what can the manager do on its own without getting, the consent of the members?
Right.
And typically in a passive syndication, the members are not going to have, the right to say when you can sell or how much right. So, but there may be certain things like if the deal, let's say, is projected for 10 years, can the manager keep you in the deal for more than 10 years without telling you? Or another one is, can the manager do a 1031 exchange without getting the consent of the members? That's one.
1031 is a big one.
Yeah. So those are kind of some of the most important ones. But again, it's important kind of to read the whole package, right, and understand the whole transaction.
Got it. Yeah, and you did mention accredited and sophisticated, and most of my listeners know about it, but I think let's go back and talk about that as well. What's the difference between accredited and sophisticated, and why some sponsor will choose one over the other?
Yeah. So accredited investors, really, it's just a monetary test. And you can think about, the SEC way back when, after the markets crashed, in the late 20s, when the securities laws came out in 33 and 34, they said, okay, well, there's a certain level of wealth that people can have that we're going to put them in an accredited class, and they basically should be able to protect themselves, right? And it's $200. It's a annual salary of $200 or $300 with a spouse. $1 million of net income, of net wealth without your primary residence. Those are the two main ones, right? And there's a couple other metrics. But basically, if you meet those levels, you can be accredited. And the SEC has said, okay, you need kind of less protection.
Right, because you have enough money to survive.
If you lost your investment in this deal, you would still withstand it.
Right.
And sophisticated investors, there's really no exact definition, but
Right.
basically what it is you don't have the level of wealth of an accredited investor, but you have sort of knowledge on your
Investment
own
knowledge.
as an advisor. You've invested in those types of syndicated deals before. There's something about your education or your experience that makes you sophisticated in these types of deals.
Right. And so sophisticated investors are only allowed in 506B regular, right?
That's
And
right.
506C only allows accredited investors.
That's right. So, I don't know how much in depth on the different regulations and differences, but, the typical transaction that you think of, the country club or the high net worth people who, the doctors and lawyers and,
Right.
The sponsor has this sort of network. That's the traditional 506B, right? And
Right.
the trade-off is you're not allowed to solicit.
Right. You can't advertise.
Pop up on LinkedIn or,
Yeah.
post in the Wall Street Journal. But you can have up to 35 sophisticated but non-accredited investors. Now, I will say, in my practice, we counsel, if possible, right, only have accredited investors, even if you are able to have sophisticated. And the reason for that is the disclosures for sophisticated investors are much more fulsome and therefore more expensive for the sponsor.
Ah, I see.
So
506B is a little bit more expensive as well.
Well, 506B if you have sophisticated investors.
I see. Okay.
So it's not only 506B versus 506C, but it's 506B if you choose to include sophisticated.
I see.
And again, 506C, which is newer with the Jobs Act, allows you to solicit generally, but you can only use accredited investors and those who are verified.
Correct. Yeah, you have to use third-party verification.
Right. That's right.
Correct. Okay. No, that's awesome. So now I want to pivot because you have been doing this for a while. What are some of the gotchas for a passive investor while they are investing in syndication, right? Especially, what are some of the red flags they can just see by looking at operating agreement or PPM and whatnot?
Yeah. I mean, I think, the first thing to know is there can be a perfectly drafted operating agreement, perfectly drafted package. But if the sponsor is, going to commit fraud or they're not a good sponsor, it doesn't really matter what the documents say. I mean, you hope that the sponsor that you're investing in has a professional package. It's, put together well, has an attorney that is known in the field. I think that's obviously a plus. But even separate and apart, taking a step back from the legal ramifications, you want to do diligence. You want to talk to other investors who have invested with that sponsor before. I like to meet, even in this, maybe not now in the current practice, but I like to sit down face to face if I can and meet the sponsors. And know who their advisors are and who else has invested with them if possible. But then when you get to the documents, right, it's all the things we just mentioned. You want to look at, are the distribution, waterfall provisions, do they reflect the market? Is this a totally out of whack deal that isn't what everybody else is doing? Do these guys not know what they're doing? Are they taking a lot of fees up front, or are their interests as a sponsor aligned with the investor? That's really important. You don't want a deal where even if the deal doesn't perform, the sponsor gets all these fees.
Yeah, that's like fund managers.
That's right. And again, you don't want to be you don't want to have mandatory capital calls where if the deal goes bad, it should be the sponsor who's taking that liability or maybe getting some bridge financing, but you shouldn't have to be putting additional capital in. Unless you know that it's up front. Maybe some construction deals where there's more risk, but typically passive investors do not want to and shouldn't be funding, additional mandatory capital calls.
Absolutely.
Yeah.
So you did mention the fees, right? And the fees I have seen typically are the acquisition fee. There is refinance fee sometimes if they are
Yep.
refinance and disposition fee. Have you seen any other fees? And can you tell us more about what the ranges have you seen these fees are in, like
Sure.
acquisition, disposition? But are there any other fees have you seen?
Yeah. Yeah, there are other fees, and it also depends on if the sponsor is self-managing, right? I mean, there's
Right.
typically a
Yeah.
property
Then you have
management
property
fee, whether
management.
that's
Yes.
combined with an asset
Asset
management fee
management.
from the
Yeah.
sponsor, or it's a third-party property management fee. There's sometimes just general management fees that if it's a construction deal, there can be construction or development fees or construction
Oh, right.
oversight fees. And typically, acquisition fees are in the 1, maybe 2% range. I think same with disposition fees.
Right.
Property management fees, 3, maybe 4%,
Right.
or
3 to 5.
the sponsor self-managing, maybe there'll be a 5% asset management fee, which includes property
Property
management.
management. Right.
Occasionally there will be a sort of like a capital. It's called different things, but in essence, it's a fee based on the capital that is brought in.
I
That's
see.
that's more unusual to go to the sponsor, but I have seen that.
Really? Wow.
I think those are sort of the typical fees that you see.
And do you, because you work with syndicators and of course on the real estate
Yeah,
side too, has any time any passive investor reached out to you to review the PPM they are investing in?
yeah, I've done that a lot actually,
Okay.
and it's people who are really getting involved in multiple deals. They're starting to see a lot, especially leading up to the last, let's say, 3 to 5 years. There's been a lot of new syndicators.
Right.
Crowdfunding obviously has
A
taken off.
lot. Yep.
So we've had a lot of people, whether they're in tech or whatever, and they're, getting into real estate. There's a lot more access now. So certainly we review the documents on behalf of investors, and we know where all the bodies are buried and
Right.
what to look for, because we represent all the the folks, the sponsors on the other side. So
Exactly.
we
And
know what to
yeah.
look for.
That's why I asked that. It's
Yeah.
sometimes if you're starting out, and even personally me too, if 4 or 5 years ago, if I had reached out to an attorney like you and let him or her review the documents, that would have been nice, right?
Yeah,
That,
that's right.
and that will teach me things to look for as well, right?
Absolutely. And the nice thing right now is there's these crowdfunding websites where you can register, and
Yeah.
even if you aren't going to, day one want to invest in a deal, you can pull down some operating packages
Yes.
and operating agreements and PPMs and start to sort of get a sense and feel for what the typical provisions are, and what is market in the type of syndicated deal that you want to invest in.
Got it. So the last question is, again, as a passive investor, let's say if the asset is not performing, or if the investors lose some or all of the principal, is there a way investors can go after that operator or syndicator?
Well, the answer is your favorite answer to hear from your attorney is it depends. Right? I mean,
Exactly.
it does. It
Right.
really depends on what the documents say. It depends on how much money you and whoever else is joining in this group. How much money is at stake. If you invest $25,000 and you lose that money, unless there's obvious fraud or something, it's may cost you at least that much to
Right.
investigate and hire lawyers. And so, but if you have invested $25,000 and there's 10 other people who
Right.
you all feel like you've been defrauded, sometimes it makes sense, right? And we take a quick look at the documents and say, wow, the manager was supposed to do X, Y, Z, and
Right.
clearly he didn't. Or sometimes we'll look at the documents and say, well, the deal performed badly, but they disclosed that there wouldn't be any operating income for the first year, and they said this was a risk, and that. So it really does depend.
Right.
And look, a sponsor doesn't want to have a reputation of
Right.
being, sort of somebody in the market that is not doing right by their investors. So even
Right.
sometimes, we've been hired, you write a letter and the sponsor wants to work with you because they see that the investors are serious and they've hired counsel and, but not always, right? I mean,
Right.
working on a matter right now where the property was sold and the sponsor took a bunch of money and maybe didn't put the money in that he himself was supposed to, and he's ignoring us so far. So
Oh, really?
it
Wow.
really is, very dependent on the specific
Right.
sponsor, what happened in the deal, and all kinds of factors.
So can you go after any sponsor for negligence or incompetence?
Um, it has to rise to the level of fraudulent activities or gross
Okay.
negligence.
Okay. I
Having
see.
said that, if it depends on what they put in their documents and what they're
Right.
supposed to be doing.
Yeah.
Hopefully you find out that they're incompetent before when you do your diligence and talk to other investors about that sponsor, right? But sometimes when you're in a deal and it goes bad, you call somebody like my firm and you kind of see what your options are.
Got it. So can you give an example or two where now you just mentioned about this one where the property, do you have any other example where you are able to go
Um,
after the sponsor? And again, we don't have to go in the detail.
yeah, no, gosh, there's so many horror stories.
I'm pretty sure. And
Let's
that's what I
see.
want to highlight, right?
Yeah.
The horror stories.
I mean, we had a transaction where the sponsor was supposed to be building properties in Belize, and it just, was basically a big pyramid scheme, and he kept doing different tranches and promising things, and there would be like little developments that he would point out to the new people,
Wow.
um, and that's a little harder, right? Because it's an overseas transaction.
Yes.
So that was an interesting one. The one I just mentioned, the guy basically was supposed to build and develop this project, and it sort of got, again, partially developed, and then when you look in, we started asking questions and doing diligence, and then you look at title, and it looks like, there was a default and a foreclosure from the second lien. He didn't probably put in his contribution that he was supposed to put in. There's all kinds of things that have happened on. We could have a whole nother episode on war stories and deals, but it's again really, really important to do that diligence and find out as much as you can about these sponsors from the beginning. And look, there are deals that legitimately, especially with what's happening right now, that don't perform.
Right. That's
And
exactly
they go
why.
bad. But the good sponsors, when that happens, instead of communicating less, they communicate
Communicates
more,
more. Yeah.
right? They
That's the
communicate
key.
more,
Transparency. Yeah.
right? And maybe they don't take their fees,
Yeah, of
or
course.
they and you do well and have a longevity in this business by not just making a bunch of money from your investors in one deal, but having them repeat and tell their friends to
Yes.
invest with you, and so those
That's the
are,
key. Yeah. Repeat customers. And this is a
yeah,
relational business. It's all about networking. You got to,
that's right.
yeah.
and
So,
and finding sponsors maybe that have been through downturns before,
yes.
and not just the last 5 to 7 years
Right.
where
Yep.
everybody's making money.
Everyone,
So
every
still,
monkey can make
always,
money.
that's
So,
right.
anything else, Riga, about syndication we did not discuss or I forgot to bring up?
No, I don't think so. I mean, I think, look, it is really important when you're dealing with these sponsors to understand that it's not just a real estate transaction, it's a securities transaction. So hopefully your sponsors understand that, and they have competent counsel, both real estate and securities. And again, I know I'm a lawyer and it's, a show about legal syndication, but it really, doing the diligence and just getting comfortable on a business level with the sponsor is almost more important than reading every word of your legal documents. Although you should do that too.
Got it. Absolutely. So the last question I have, and it's not syndication anymore. Any business or real estate book you recommend?
Oh gosh, there's so many. Let's see. And some of them are about syndication. I have a client, Hunter Thompson, who has
Oh
a
yeah, yeah.
real great book on raising capital for real
Yeah,
estate
Hunter
syndication.
is a good friend, and that's how we
Oh,
are
good.
connected.
Okay.
That's
Yep.
how we
Yeah,
were
that's good.
connected, right?
That's how I totally forgot
Yeah.
about that for a minute. I like, I know, Grant Cardone can
Uh-huh.
rub people the wrong way. Sometimes some people love him and hate him, but his book 10X,
Yeah.
I think is a great investing book. There's another guy, I don't know if you know Lee Goosens, who's Australian.
Oh, I
He
don't
has
know
a
that.
book called Investing in the U.S., an Aussie's Guide to Real Estate Syndication, which has, even if you're not a foreigner, has a lot of great information
Oh, okay. I got to look
across
that one up.
the board for investing in real estate and syndications. Let's see, what else? There's so many. Rich Dad Poor Dad.
Oh yeah, that everyone recommends, and I've been talking about it forever.
Shifting a lot of people's minds and
Yes,
classic.
yeah, that is a classic, no doubt.
And then I read Ayn Rand. I mean, there's lots and
Right,
lots of things that are not officially business books
right.
that I could recommend as well.
That's awesome. Thank you so much. How can my listeners
Absolutely.
reach out to you?
Yeah, the best way is to hop on either our website, which is www.sklarkirsh.com. It's sklarkirsh.com. You can feel free to email me, pfischer, Fischer, @sklarkirsh.com. Those are probably the two best ways. I'm happy to answer any questions. We normally have an initial consultation call free with anybody who wants to chat and see if it's worth working with us. And again, always interested in, I'm an investor myself, always interested in meeting fellow investors and expanding the network. So
Absolutely. Oh, that's awesome. Thanks again, Peter, for taking time out of your busy schedule. Appreciate it.
yeah, thank you for having me. Enjoyed it.
Of course. Take care and stay
All
healthy.
right. Yes, you too. Thanks again.